Hey, what's happening? This is Jerry over at Wealth Dynamics. Hey, I want to give you a real quick webinar today on wealth creation banking. Okay, what is wealth creation banking? Wealth creation banking is what we use as the sacred account, if you will, for our clients to save until they're ready to invest in real estate. So we recommend that our clients save 40% of their income, just like the top 1% does. A portion of that income we recommend putting into wealth creation banking. Now, what is wealth creation banking really? At a basic level, wealth creation banking is a properly structured whole life insurance policy. Okay, so it's called a high early cash value dividend paying whole life insurance policy. That's a mouthful. I want to break that down for you really quick. So a high early cash value, meaning the monetary value, the liquidity on that policy is very high during the early years. So that's that statement. Dividend paying means the policy actually pays you dividends. Okay. And then basically a whole life insurance policy is the actual method we utilize to structure this. It's going to be a whole life insurance policy. Now, I want to go over some of the features and break a few myths really quick with you. So we've been taught a couple things about whole life insurance. I actually used to be a Dave Ramsey endorsed local provider. So anything you've heard about life insurance, I've heard 10 times more of it. And I've also taught the same things that you're afraid of. So I want to go over some of the myths that I personally learned and I didn't know about. Like I was teaching Dave Ramsey stuff for a long time, and I finally learned this method instead. And it took me a little bit to understand why it works differently than what I was taught. But once it did, it made total sense to me. Okay. So I want to break this down for you. And so here's what I'm looking at. Now, the companies we're going to work with, they have a 160 plus year track record. So I want you to think about if this was a ripoff, how would it be successful, sir, for a century and a half? Okay, don't you think after 150 plus years, people would be like, hey, that doesn't work. Nobody would use it. There'd be no need for it. Okay, so think about that. Now, the company does pay a 6 to 8% dividend. I was taught that there was no growth with whole life insurance, that it's not something you put money into to grow. The reality is, over the last 160 or so years, the average annual dividend has been a 6 to 8% gross dividend payout. Okay, now there is a 4% guarantee. I was taught, that you don't get any of your money, you don't see your cash value for several years, and that you're guaranteed nothing, that you can lose your cash value. That's not true either. Okay, you're actually guaranteed to have at least a 4% dividend payout. Okay, no matter what, you're always going to have at least a 4% dividend, but on average, it's going to be 6 to 8. Now, the money in the policy does grow tax-free. Okay, so that's a benefit. So when you put money in a life insurance policy, because of the way that it's structured, it grows tax-free. And we'll kind of go over some of the benefits. And I do want to talk to you today about how you can borrow against this account. I was taught that borrowing is a terrible idea because why in the world would you pay interest on your own money in order to access it when it's already not growing and it's already not doing all the things you need it to? The reason that this is tax-free is because you're borrowing against it. Okay. Otherwise, if you have a profit, you're making the 6 to 8% dividend. At some point, you're profitable on the policy. If you pulled out profit in a policy, you would pay taxes. The reason you don't pay taxes is because the IRS cannot tax a loan. Okay, so I want you to ask yourself who you'd rather do business with. Okay, would you rather do business with an insurance company that's going to pay you profit or with the IRS? They're going to try and tax you and not pay you anything. Okay, now the reason why you get a dividend in the first place is this is what's called a mutual insurance company. A mutual insurance company means that a policyholder equals a shareholder. As a shareholder in the company, you receive dividends when the company is profitable. These are financial giants, so they've been profitable for 160 years in a row. That's what we're saying here. You would be making that dividend every single year for the last 160 or so years, depending on what company you went with, historically speaking, okay? So you're buying life insurance with a company. That company is giving you a high early cash value, meaning that you can access your funds immediately. When you have those funds in there, those funds earn a dividend because you're a shareholder in the company. Okay, now also think about this. When you have those funds in the account, because you're an owner, you borrow against your policy from the insurance company. Okay, so instead of pulling out, let's say you have 100 grand, instead of pulling out your 100 grand, you're going to borrow it from the insurance company, meaning your money never left the account. Okay, think about that. Let's say you put $100,000 in a savings account. They're paying you a 1% interest rate. That's awesome. When you take the 100 grand out, they're not going to keep paying you the 1% on the $100,000 that's no longer in the bank, right? With the life insurance, because you never withdrew it, you took a loan instead, you're still earning a 6 to 8% dividend. Okay. Now, when you're borrowing, you will pay interest to borrow. There's two options here. You can set the interest rate so that it's the same as your dividend, meaning it cancels it out. It cancels it out. It's fixed. Or you can set the interest rate to where it's variable, meaning it's going to be lower than your dividend. Okay. So a variable interest rate, an example would mean I had 100 grand in my policy. I borrowed against my policy at a 5% loan rate. But because I borrowed, my interest still kept growing at 6% on my dividend, and I made a 1% spread. Okay, that's the leverage aspect. Now, this is life insurance as well. It's an immediate asset. It creates an immediate estate, which can go to beneficiaries. The other thing about life insurance that most people don't know is you can sell your life insurance to investors. They can cash you out while you're still living, so you can make money on it that way too. Okay, now I want to show you some of the advantages here. So before I jump into this, to put this very clearly, this is life insurance. Okay, so the wealth creation banking, the sacred account, infinite banking, whatever you call it, it's life insurance. Okay, it has a high early cash value. It's going to grow at a 6 to 8% dividend. It's tax-free because you borrow against it instead of taking withdrawals. And that also gives you the ability to leverage the account and make money on the account, even though you're still using those funds. Okay, now a real quick note on interest. The interest is only due once a year. It's interest only. Okay, so basically if I have 100 grand, I borrow at 5%. Once a year, I'll pay 5 grand, and that's interest only. I don't ever have to pay the principal back if I don't want to, and we're going to talk about that in a second. Okay, now before we talk about this, this is compared to a bank account. So I'm not saying do this instead of real estate. I'm not saying do this instead of the stock market, even though I do think that. I'm telling you, you're going to do something to invest. Until you invest, you'll need somewhere to put money. This is better than the bank. You put money in a bank or you put money here, you'll make more and get there faster if you put it here instead. Okay, that's what I'm saying. So real quick comparison, account 1 versus account 2. Okay, I'm going to have you guess which account is which at the end of this. Okay, account 1 earns 0.10% interest. Okay, so think about that. You're going to make 0.10%. Account 2 earns 6 to 8% interest. Okay, which would you rather have? Account 1 has a 0% guarantee, meaning that when you put money into it, you're never going to lose, but you also aren't guaranteed to make anything. Account 2 has a 4% guarantee, which means when you put money into it, you're never going to lose, and also you'll always have at least a 4% interest rate or dividend earned. Okay, now the advantage on account 1 is when you put in your money, it's 100% liquid as long as it's still there. We'll talk about that in a second. So if you give them $1 and you go check your account that day, you will have $1 in your account. You can take that $1 out immediately. Account 2 is 75 to 95% liquid. Okay, now with account 2, the money is always there, and we'll talk about what that means in a second as well. Now what that means for the liquidity, like we said with account 1, you put in $1, you're going to have $1. With account 2, you put in $1 and you can immediately access 75 to 95 cents. Okay, so the only advantage account 1 has is when you give them $1, you can pull out the entire $1 immediately. With account 2, you give them $1, you pull out anywhere from 75 to 95 cents of that $1 immediately. You don't get access to the full $1 from day one. Okay, that's a difference there. Okay, account 1 can be accessed by the bank. It can be accessed by the federal government. It can be accessed by creditors. It can be accessed by the IRS. Okay, account 2, it's protected. Only you can access it. It's called a unilateral contract. It's the same concept as a trust. It's something the wealthy have used for centuries. Okay, so which one would you rather have between those two? Now, account number 1, when you give them money, they loan your money out at a 10-to-1 ratio. So that means that if you give them $1, they will loan your $1 out to 10 different people at the same time. They only have to keep 10 cents in reserves. Okay. Now this is what I meant by as long as the money is still there. In account one, when you give them the dollar and ask for your dollar back, they'll give it to you as long as they didn't overextend themselves. Okay. This is called fractional reserve banking. What this means is when you give the bank a dollar, they're allowed to loan that dollar out 10 times on the dollar you gave them, and they pay you absolutely nothing for that. Okay. Think about what that would mean. If you had $1,000 in there and they loan your $1,000 out to 5 people and they charge each of those 5 people a 5% interest rate, what did they just make on your money? They made 50%. Now, what are they paying you? They're paying you 0.10%. Okay. Now, there's nothing wrong with that if they told me that they were doing that ahead of time and if they cut me in on the deal. Now, they didn't tell you that ahead of time. You know, no one knows that that's what the bank does with their money, and you don't see any of the performance from that. Okay. Now, in a comparison account number 2, they give you ownership. So when you give them a dollar, they give you ownership in the company and they pay you profit. So they're not lending it out to 10 other people and not telling you about it and paying you nothing. They're making you a shareholder in the company when you give them money, and they're paying you profitability based on how that company performs. Okay. Now, account number 1, the money doesn't grow at all when you're in there, nor upon withdrawal. Okay. Account 2 has leverage. The money grows at a 6 to 8 dividend inside the account. And when you withdraw it, it still continues to earn that 6 to 8% dividend. Account number 1 is taxable. Account number 2 is tax-free. Okay, think about that. Would you rather pay taxes on nothing, or would you rather pay no taxes on something? Kind of a no-brainer. Account number 1 has no death benefit. When you die, you only get what's in the account, okay, which is normal. But account number 2 has a death benefit. When you die, your beneficiaries get more than you had in your account. Think about what that means. If you had $1,000 when you die, but you pass away and your beneficiaries get $2,000, that's a good deal. Account number 1 received government bailouts. Account number 2 did not. Account number 1 has transaction fees, ATM fees, overdraft fees. Account number 2 has absolutely no transaction fees. Account number 1 takes 72,000 years to double your money. Account number 2 only takes you 12 years to double your money. Account number 1 promotes central banking. If you're not familiar with that term, please Google it, or you can ask me. Account number 2 does not involve central banking at all. Account number 1 has no financial transparency. When you give them the money, you have no idea what they're doing. Account number 2 has full financial transparency. You can see their entire profit and loss and balance sheet right on their website. Why? Because you're a shareholder. Okay, so before we dive into numbers, those are the main differences. If you haven't guessed it already, account number 1 is a bank account. Account number 2 is a life insurance policy. Okay, based on the description, which one would you have picked? Regardless of the title, before you heard the title, which one would you have picked based on description? 9 out of 10 of us would have picked the wealth creation banking, the life insurance. I say 9 out of 10 because we still have to make room for one unintelligent person out of the bunch. That's okay. Okay, now I'm going to dive into numbers with you. So this is showing a 35-year-old putting in $100,000 a year in 3 different accounts. Okay, this one on the far left or the far right-hand side is a bank. Okay, now to be specific, this is a local bank that is in my city. We actually went to their savings page and looked at their rates. And if you gave them $100,000, they would pay you 0.10% in interest. Okay, so here's what that looks like in year 1. Now you're doing that $100,000 every single year. You're doing $100,000 every single year for 30 years. Okay, so if you did that in year 1, you would have made $100 in interest. Okay, by year 2, you would have made $300 in interest. By year 3, you would have made $600 in interest. Think about that, $300,000 and you made $600 in total interest. Okay, that's $100 per year per $100,000 you've put in. Over that 3-year period, that's going to total up to, you've earned a total of $600 in interest payments. Okay, now if we go all the way down to 5 years, you've put in $500,000. By year 5, you've earned a total of $1,500 in interest. 7 years, same thing. Okay, and so you go all the way down to the end. After 30 years, you've put in $3 million. and you've earned $46,000 in interest. And that's only if you never withdrew the money. If at any point you withdrew the money, you would have interrupted the interest cycle and you wouldn't have made $46,000. You would have made less based on when you withdrew it and if you put money back in it or not. Okay, so this is the next one. This is life insurance policy A. Okay, this account is showing lower liquidity but higher overall growth. So here's what we're talking about. If you put in $100,000, you'd be able to pull out $71,493 in year one. You would also have an $8 million death benefit, which means if you died, your beneficiaries in year one would make $8 million, even though you only gave the insurance company $100 grand. Okay. Now the downside is in this account, you can only access 71,000 versus in the bank, you could access 100,000. Okay. That's the only downside here. Now let's see how this plays out though. By year 5, you have a balance of 494,000 versus the bank's 501,000. Okay. By year 6, you've actually outpaced the bank. Okay. You now have 614,000. The bank only made a total balance of 602,000. So as you can see, if you can wait 5 to 6 years with this account, it's going to outpace the bank. Now the benefit is, guys, when you withdraw this money, it's still going to grow. From year to year, it's still going to grow. So if you withdrew $614,000 in year 6, by year 7, including an additional 100,000 you contributed, your total balance would grow to 741,000. With the bank, if you pulled out the 602,000, it would be gone. You would contribute another 100 grand, but your balance would only be 100,000 because you took out the 600 grand. Okay. So here's what we're looking at. By year 15, this account outpaces the bank by $500,000, and you have a $6.6 million death benefit. If you die, your beneficiaries get this number instead of this number. So they get a 300% return. Not bad. By year 30, you have $6.8 million in the account and a $12.6 million death benefit versus the measly $46,000 in interest you earned on top of your $3 million with the bank. Okay. So on the life insurance over 30 years, you put in $3 million and you turned it into 6.8. With a bank over the life of the account, you put in 100 grand and you only made 46,000. Okay. That's option A with the life insurance. Again, lower liquidity initially, but higher overall growth. And the reason I say that is because if you compare this to the next account over, this is a life insurance policy as well with a different design. As you can see, the liquidity is higher. Okay, you have a higher overall liquidity. You're actually able to access about 75 grand in year 1. Okay, and as you can see, this account over the long term doesn't perform as well. Okay, and the reason why you would do something like this is if you needed more money up front and you weren't concerned about the overall growth, you would choose option B. If you were concerned about long-term growth, you would choose option A. In neither circumstance would you really choose the bank. That's just a terrible idea. Okay, now if you fast forward, you can see this account underperforms the middle option throughout the rest of the policy life. The only years you're ahead is really year 1. Okay, and the reason why is you purchased more shares. Remember I said that when you buy a life insurance policy, you're buying the death benefit, and when you own death benefit, they treat that like a share. So in this one, you own more death benefit. That's why you have lower liquidity, and you have more shares, which means you're earning more in dividends. And those dividends make this account grow faster than the other option. In this account, you're buying less shares. You're buying less death benefit. Because of that, you had more money left over to put in the cash value to borrow against, but you're not going to grow as fast because you're not getting as much in dividend income. Okay. So those are the two main differences. A couple things I want to show you here. With the bank, as I said, when you withdraw the money is gone. They're not going to keep paying you interest. With the life insurance, when you withdraw the money, it's still going to grow. Okay. It's still going to continue growing year by year, even though you took the money out. That's the benefit of doing this. Okay. So when you're using life insurance, the reason we set these accounts up is to borrow against the account. So let's say right here, you've got almost $500,000. Let's say you borrow all of that money. You would go buy income producing real estate. Okay. That real estate would cash flow and you would pay yourself back with that cash flow. taking advantage of the positive growth of this account simultaneously while you're investing in real estate. So guys, I wanted to show you this. The reason why is there's a lot of myths out there about life insurance. I was in the industry for about half a decade before I learned that this is real and it's something that the wealthy have used and that you can even do it this way, okay? Most agents won't write this kind of policy because the only way you can have all this money left over in the cash value is for the insurance company not to pay out a giant commission to the agent. So this does reduce your commission by about 60%. And so most agents financially are not incentivized to write a policy like this because it reduces their paycheck. So if you're interested in learning more about this, I want you to reach out to me. There is a link in the description that's going to give you some more detail on this exact policy. Thank you for watching. If you like this, make sure that you like, share, and subscribe. I will talk to you guys again next time.